Every nation on this planet is drowning in debt. The United States alone carries over $38 trillion, the highest in its history. Japan's debt pile has surged past $9 trillion. The European Union collectively owes around $14 trillion. Even oil-rich nations like Saudi Arabia and export powerhouses like Germany and China owe staggering sums. But here's the paradox that nobody talks about. If everyone is in debt, who exactly are we all in debt to? It's the architecture of modern power. Debt isn't just money owed, it's control distributed. It's the invisible framework holding up wars, crises, empires, and collapses. But that doesn't mean everyone benefits equally. So how did we get here? How did a planet drowning in over $315 trillion of debt, nearly 3 times the size of the global economy, reach this point? To understand that, we need to go back centuries, long before credit cards or digital transfers, back to when the idea of national debt wasn't born on Wall Street but on the battlefield. Let's start with America, because its debt isn't just national, it's global in nature. That $38 trillion isn't held by one country or one entity. Roughly half of it is in public hands, meaning it's owed to investors, not just other government institutions. About 2/3 of those investors are American: banks, pension funds, mutual funds, insurance companies, and the Federal Reserve itself. The remaining third, around $9 trillion, is held by foreign entities. But here's where it gets interesting. When people say America owes money to China, they're technically correct, but China only holds about $800 billion of that debt. That's roughly 2% of total U.S. obligations. Japan actually holds more, around $1 trillion. Then comes the United Kingdom, Luxembourg, and Belgium, so America owes most of its debt to America. The Treasury issues bonds. Banks and funds buy them. The Federal Reserve often buys them back, creating new dollars in the process. Americans pay taxes to finance the interest on these bonds, and that interest then flows back into American retirement accounts. It's a circular mirror. The debt is real, but the creditor is largely an image of the same system. What does this mean for the average American? It means your tax dollars are funding interest payments that flow back into pension funds and investment accounts, many of which might include your own retirement savings. You're both the debtor and the creditor. The system feeds on itself, and as long as confidence holds, it keeps spinning. But what happens when that confidence cracks? When investors stop believing the government can pay interest, even if it can't pay the principal? That's when yields spike, currencies collapse, and economies restructure overnight. We've seen it before, and we'll see it again. Japan's debt now exceeds 250% of its GDP, making it one of the most indebted nations on Earth relative to its economy. Yet Japanese government bonds yield close to zero. Why? Because investors don't expect repayment. They expect renewal. Japan has been rolling over its debt for decades. Old bonds are replaced with new ones. Interest becomes the real product. Stability is the rent. And the system keeps going because Japanese institutions, primarily domestic banks and pension funds, keep buying. They don't see the debt as a burden. They see it as the safest asset available. This creates a strange dynamic. Japan doesn't owe money to foreign powers demanding payment. It owes money to its own citizens, who reinvest that money back into the same system. It's a closed loop of obligation sustained entirely by internal trust. But here's the risk. Japan's population is aging rapidly. As more retirees draw from pension funds, those funds will need to sell bonds to pay out benefits. If too many bonds hit the market at once, yields could spike, interest payments would explode, and the entire structure could fracture. Japan's debt isn't dangerous because of its size. It's dangerous because of its internal dependency. For years, China was the world's banker, accumulating massive foreign reserves by exporting goods and buying Western bonds. Chinese institutions hold over $3 trillion in foreign assets, much of it in U.S. treasuries and European debt. But China's role has shifted. It's no longer just lending, it's borrowing. Local governments in China have racked up enormous debts, financing infrastructure projects, real estate developments, and state-owned enterprises. Total Chinese debt, including corporate and government obligations, now exceeds 300% of GDP. And much of that debt is hidden. Shadow banking, off-balance sheet financing, and opaque local government borrowing make it nearly impossible to know the true scale. What we do know is that China's debt has grown faster than any major economy in modern history. So who does China owe? Mostly itself. Chinese banks lend to Chinese companies. Chinese companies borrow from Chinese institutions. The government guarantees much of it, implicitly or explicitly. It's a domestically contained system, but one built on land valuations, infrastructure assumptions, and growth projections that may not hold. If confidence breaks, if property values collapse or exports slow, China's debt could become the next global crisis. And unlike Japan, China's system is far less transparent, making it harder to predict where the cracks will appear. Europe's debt situation is unique because it's not a single nation. It's a monetary union without a fiscal union. Countries share a currency, the euro, but maintain separate budgets, tax systems, and debt obligations. Germany, Europe's economic engine, carries significant debt but enjoys low interest rates because investors trust its ability to pay. Greece, on the other hand, faced near collapse in 2010 when its debt became unsustainable. Bondholders panicked. Yields spiked. The European Central Bank and IMF intervened, but the bailout came with austerity, tax hikes, spending cuts, mass unemployment. Italy and Spain sit somewhere in between. Both have large debt piles relative to GDP, but both are considered too big to fail. If either collapsed, it could trigger a domino effect across the Eurozone. So who holds European debt? A mix of domestic banks, pension funds, the European Central Bank, and foreign investors. The ECB has been buying bonds for years, effectively monetizing debt to keep yields low. But that can't continue forever. When the ECB stops buying, or when it starts selling, interest rates will rise, and the weakest economies will feel it first. Europe's debt isn't just an economic issue, it's a political one. Every crisis tests the unity of the Union. Every bailout creates resentment, and every austerity measure fuels populism. The debt might be technical, but its consequences are deeply human. Countries like Argentina, Turkey, Sri Lanka, and Lebanon face a different kind of debt trap. They borrow in foreign currencies, primarily US dollars, but earn revenue in their own weaker currencies. When their currency devalues, their debt burden explodes. Argentina has defaulted on its debt 9 times in its history. Each time, creditors take losses, the government restructures, and new loans replace old ones. But the cycle never ends. The country remains stuck in a loop of borrowing, defaulting, and renegotiating. Sri Lanka recently ran out of foreign reserves to pay for fuel imports, triggering political collapse. Lebanon's banking system imploded, trapping depositors' savings and sparking mass protests. Turkey's currency has lost over 80% of its value in recent years, making its dollar-denominated debt nearly impossible to service. Who do these countries owe? A mix of international bondholders, the International Monetary Fund, World Bank, and foreign governments. When they default, the IMF steps in, but the bailout comes with conditions: currency devaluation, spending cuts, and structural reforms. The system doesn't collapse, it restructures, and the same logic starts over. For citizens of these nations, debt isn't abstract. It's fuel shortages, currency collapses, and lost savings. It's the direct cost of being on the wrong side of the global financial system. Behind every government bond is a network of institutions: hedge funds, pension funds, sovereign wealth funds, and central banks managing tens of trillions in assets. They are the real arbiters of debt. They decide which countries can borrow cheaply and which must pay a premium to survive. lose their confidence and currencies collapse, governments fall, and entire economies can be restructured overnight. Democracy decides who governs. Markets decide who survives. And the ultimate market maker, the modern high priest of this system, is the central bank. Central banks don't just manage debt, they create it. Every time the Federal Reserve or European Central Bank buys government bonds, they create new money in return. One balance sheet's liability becomes another's asset. Every dollar in circulation represents a unit of debt somewhere else. There is no such thing as debt-free money. So when we say, we owe it to ourselves, that's only half the story. Interest payments don't flow equally across society. They flow from taxpayers and workers toward institutions and investors holding the debt. So debt isn't just a transfer between countries. It's a transfer between classes. Here's the secret. Governments don't actually plan to pay off their debts. Not now. Not ever. This isn't a conspiracy. It's policy. When you or I take out a loan, we're expected to pay back the principal. But governments take a different approach. They treat debt like a permanent subscription, issuing new bonds to close out old ones. Economists call this refinancing. Interest becomes the real product. Rent for stability. Today's global economy depends on this rent. It's like a shark that must keep swimming to breathe. The global financial system today is based not on repayment, but on trust. The United States will never pay off its $38 trillion debt. They'll refinance it forever. Japan has been rolling over its debt for decades, now exceeding 250% of GDP. Yet government bond yields remain near zero because investors don't expect repayment, they expect renewal. Why? Because for them, national debt is the safest security. A U.S. Treasury bond isn't considered a liability. It's an asset, the foundation of global markets. Pension funds hold it. Banks use it as collateral. Central banks treat it like money. The system depends on governments never paying off their debts, because otherwise the world would lose its most reliable financial instrument. Imagine if Washington decided to pay back every last dollar of its debt. Banks and funds worldwide would suddenly lose their most stable assets. Dollar supply would contract significantly, triggering deflation and collapse. Paying off the debt would destroy everything the economy depends on. So governments do the opposite. They spend more and more, not recklessly but rhythmically. Debt becomes a kind of heartbeat of capitalism, coursing through every mortgage, every pension, every market alive in the world. So who does the world owe money to? Not China, not Wall Street, not the IMF. All of them. And us. The modern financial system has turned debt itself into money. Governments issue it, banks multiply it, investors trade it, and citizens trust it. The line between debtor and creditor has blurred beyond recognition. Debt once meant slavery. Today, it means balance. But if that balance tips, if trust breaks, the illusion will end, and we'll remember once again what debt really is. A promise that can't be kept forever. If this gave you a new perspective, subscribe. History has the answers. I'll show you where to look.